Welcome back to Portfolio Playbook. I'm Dominic Dantes, founder of Dantes Outlook. We're a boutique investment advisory firm that builds tailored portfolios for individuals, families, and institutions worldwide. Today, we're continuing the discussion on investing through market cycles, and specifically how focusing on durable price trends and dispersion can help you navigate those cycles with more stability than relying on any single style. One thing is constant. No strategy wins all the time. Trend followers have great years and painful whipsaws. Value has its winters and its springs. Momentum runs hot until it doesn't. That's why our team combines trend, relative strength, and price dispersion to smooth that experience. We're not trying to be the fastest or the flashiest. We're focused on consistency across regimes, because that matters far more for long-term wealth than catching the perfect trade. You see, every strategy is cyclical, and your job as an investor is to strike that right balance between long-term return and emotional reality of risk. When you're in the middle or later stages of your accumulation years to retirement, say mid-30s to 40s, a deep drawdown can do some serious damage, not just to your account, but also to your behavior. A 20% hit late in the cycle can trigger FOMO, or fear of missing out, some revenge trading, or abandoning your risk mandate altogether. And if that drawdown happens right as you enter retirement, you face one of the most dangerous forces in finance. We call it sequence of return risk. This is the silent killer of a lot of retirement portfolios that we've seen. If markets drop early in retirement, you're forced to withdraw from a shrinking base. You sell more shares at depressed prices, shrinking the capital that could have been compounded during that recovery. And that can accelerate portfolio depletion, slash some long-term growth potential, and in many cases, force permanent lifestyle cuts. So the goal isn't to dodge every correction, it's to capture upside while staying within a risk mandate that you can stick with. And here's another practical tip that we've learned. Price charts only tell one part of a larger story. You see, markets don't know when you entered. They don't know your time horizon, your risk tolerance, or your retirement date. So sometimes it's helpful for us to look at rolling returns. Rolling returns show how an investment behaves across different cycles. The wins, the losses, the consistency, and the full distribution of outcomes. They strip out that start date bias and help set realistic expectations. And if you look at rolling returns for global equities, an interesting pattern emerges. Yes, U.S. stocks have dominated the last decade, and rightfully so. But historically, non-U.S. markets have a higher frequency of positive 5 and 10-year rolling returns, and they're showing signs of a potential comeback from deep valuation discounts. That's why diversification still matters. A mix of U.S. and non-U.S. equities historically delivers a better risk-reward outcome across cycles than just betting on one region. And the same is true for non-U.S. investors who are oftentimes limited to highly concentrated and less liquid markets. That's why we've always taken an independent, global, measured approach. We help the world's most dynamic investors win, not just this year, but across cycles that truly shape their wealth. We explore all of this in our Substack, available to premium subscribers and clients.